Contrary to what TikTok or Instagram influencers have been telling you, millionaires aren't made overnight. All self-made millionaires started from scratch and built their wealth over time, beginning first by mastering basic money skills like budgeting and moving on to saving and investing after that. We all want to make a fortune in our lives and join the millionaire club, but we often find ourselves stuck, not knowing where to start from and how to keep our finances under our control. Self-made millionaires have found huge success in these areas using several money habits. These money habits are practices that just about anyone can learn from, no matter your financial situation when you first start out. Here are the 8 habits that the wealthiest self-made millionaires have incorporated into their financial life that you can too. Number 1. They avoid debt. This may seem obvious, but dodging any debt is certainly a habit that can help your overall financial picture. Outside of the mortgages on their homes, self-made millionaires make sure to reduce and eliminate all debt. If you want to build wealth, you cannot waste money on paying interest on consumer credit, such as credit cards and even car loans. Because most credit cards charge notoriously high interest whenever you carry a balance, prioritize paying these balances off in full every month and on time to keep a good credit score. Only charge what you know you can pay off and avoid store credit cards in general. Store cards are notorious for having less than stellar terms. Low credit limits, high interest rates, and limited usability are the biggest downsides. If you can, then you must avoid debt completely. Avoiding debt requires you to establish a sound financial plan and steer clear of the foolish whims that bring short-term satisfaction but long-term hardship on the bank account. It's easy to run up enormous amounts of credit card debt by purchasing things you really can't afford. If debt is an unavoidable burden, then you must focus on strategies to quickly get out of debt. There are many strategies to utilize when it comes to being debt-free. Some include paying off the most expensive debt first or paying off the smallest debit first. Using a debt repayment app, increasing your income, and avoiding credit card also help. Number 2, they buy their cars and plan to keep them long-term. For the most part, cars depreciate in value the second you drive one off the lot. Self-made millionaire clients typically buy instead of lease any new car with plans to hold onto it for a while. By keeping their cars long-term, they can use the time between car purchases to save up cash that would otherwise go towards a monthly payment. If you need to finance the car, pay it off as soon as you can and plan to keep the car long after that loan is paid off. A car is a huge investment that will not only rack up costs in terms of car loans, but you also get car insurance and maintenance costs to deal with. Self-made millionaires only go for cars when it becomes a necessity and just when it won't be a financial burden to purchase one. Number 3, they have emergency funds. Having a solid reserve of cash that you can tap into in an emergency goes a long way. If you have an unexpected expense, such as an urgent car repair or medical bills, a rainy day fund that is immediately available for withdrawals can help you afford it. This way, you don't need to charge the expense onto a high-interest credit card or take out a personal loan. Self-made millionaires have 6 to 9 months of their monthly expenses set aside, while financial experts generally suggest 3 to 6 months worth of your living expenses as a baseline. You might want to consider what works for your cash flow. If you're ready to begin, start by setting smaller saving goals rather than a large one. Rather than shooting for 3 months worth of expenses right away, shoot for 1 month or 2 weeks, whatever it takes to make your first goal seem doable. Reaching that first goal can give you the motivation to keep going. Set your second goal higher, and the third even higher. By then, saving will have become a habit, and the positive motivation you're building by reaching the smaller goals will help propel you toward larger ones. Also start with small, regular contributions to motivate you to save. While saving is very important, don't devote too much of your savings to your emergency fund. By definition, an emergency fund is cash you can access quickly. That means you are most likely storing it in a low-yield vehicle like a savings account that is earning an extremely low rate of interest. For that reason alone, you should stop contributing to that account once you've reached your ultimate goal. Start depositing into an account where it will start earning money on its own. Ideally, your retirement accounts where time will enable it to bear the most fruit. Number 4, they invest. Once building up an emergency fund, self-made millionaires have organized investment plans, whether it is in stocks, bonds, or exchange-traded funds, ETFs. To do this yourself, you might want to set up a monthly or bi-monthly automatic transfer of cash from your checking account into an investment account. This way, you can forget about having to remember to manually invest, and you can then learn to live on the funds you have available. As a general rule of thumb, you should save at least roughly 20% of your income each month. This 20% goes toward your savings plans, emergency fund, retirement, and investments. How much you take out of your paycheck to invest depends heavily on your income and investment goals. But getting used to living without that 20% is a good start for both your savings and your investments. Before you invest, make sure you know how much risk you can take on and the time frame for when you'll need the money. If you are in your 20s or 30s saving up for retirement, you can generally take on a little more risk in exchange for aggressive yields, because you won't need your money for several decades if you plan to retire in your early 60s. For those in their 40s or 50s, their investment time frame for retiring is much shorter. Number 5. They don't try to keep up with the Joneses. Keeping up with the Joneses is a typical way people dig themselves into debt. Living beyond your means time and time again eventually catches up to you, and you find yourself struggling to keep up. Most self-made millionaires avoid lifestyle creep, the slow but steady creep of spending more money on luxury items that then become essential to your lifestyle as your income increases. When building wealth, you need to fight the need to have the latest and greatest gadgets. Losing so much money on constant upgrades can cost you both money and lost opportunity. It's only human to want to compare your life to others, but take another look at your lifestyle and budget, focusing on what's most important for your own personal goals. These are your needs and wants that truly matter to your bottom line and happiness. Number 6. They utilize tax deductions. When they can, millionaires try to minimize the taxes they pay. This includes finding some element of tax savings in everything from retirement plan investments to home mortgage interest, charitable contributions, college funding, and health savings accounts. For the self-employed, the TCJA in the U.S. offers a huge tax deduction benefit. The Tax Cuts and Jobs Act, TCJA, effective as of the 2018 tax year, made several changes to self-employed tax deductions. The law affects small businesses in many ways, particularly via a qualified business income (QBI) deduction for pass-through businesses, those that pay taxes as an individual taxpayers, rather than through a corporation. For owners of sole proprietorships, partnerships, S corporations, and certain trusts, estates, and limited liability companies, LLCs, this deduction provides a great benefit. Eligible taxpayers can deduct up to 20% of their QBI. Getting help from a financial and tax professional could help you get in the right information on the best plans and programs that will give you access to the best benefits and tax deductions. Number 7. They look for other income streams. Many self-made millionaires diversify their investment portfolios with other assets, such as rental properties that provide passive income. It's likely that the average person doesn't own multiple properties, but there are other opportunities that provide another source of passive income with little effort on your part. What's cool about this current digital age is there are a lot of ways to make consistent extra money, whether that is passive or active. Having multiple streams of income is not just about making wealth, but is also about financial security. Majority of people are working for a company and have a 9-to-5 profession. Unfortunately, at some point, you may be part of a layoff, which is never fun. Multiple streams will ensure if a job loss happens, you still have some money coming your way each month. It can alleviate some money stress that a job loss can bring. This way, you can avoid taking on debt to pay your bills when you're laid off. Number 8. They start saving for their kids' college early on. College costs, just like medical fees, tend to be a burden. Self-made millionaires know this and ensure that they are well prepared when the time comes. They kickstart their children's future education early so they have less of a financial burden years later. They jump into college saving plans quickly that not only provide long-term financial benefits, but also allow tax-free withdrawals when you take out money to pay for college. By getting started early, you can save a significant amount of money in future cash flow and tax savings. It does not take a lot to get started, and the power of compound returns can be so beneficial to you if you have time. As you can see from 8 Habits of the Wealthiest Self-Made Millionaire clients, there are a lot of moving pieces to having a solid financial plan. Embracing opportunities to pay off debt, save, invest, and learn, all while avoiding potential pitfalls, make a big difference on your ability to build your wealth. No matter how simple or obvious a money habit may be, the point is that you stick to it. Discipline is key, and with it, you can build the financial future you desire. Thanks for watching, and if you liked the video, don't forget to share and subscribe.